Bond vigilantes, a term that conjures images of a silent yet powerful force shaping economies and influencing governments. But who are they, and why do they matter? Welcome. Today we're exploring bond vigilantes, what they are, how they operate, and their significance in the global financial markets. When they perceive government policies as reckless or inflationary, they sell off government bonds, causing prices to drop and yields to rise. This rise in yields increases borrowing costs for governments, effectively sending a message: tighten up your fiscal policies. The term bond vigilantes was coined in the 1980s by economist Edward Yardeni during a period of rising inflation and budget deficits. So how exactly do bond vigilantes operate? It's simple. They sell bonds, particularly government bonds. This increases supply in the market, driving bond prices down and yields up. Rising yields act as a warning signal, reflecting the market's lack of confidence in a government's fiscal policies. They closely monitor factors like government spending, monetary easing, and inflation trends. Let's look at some real-world examples of bond vigilantes in action. During President Reagan's tenure, tax cuts and increased defense spending led to high deficits. Bond vigilantes responded by selling U.S. treasuries, causing yields to spike, a clear signal of market concern over fiscal discipline. In Europe, countries like Greece and Italy saw soaring bond yields as markets doubted their ability to manage debt levels. This forced austerity measures and international bailouts. In 2022, the UK's proposal for unfunded tax cuts triggered a massive sell-off in UK gilts. Yields spiked, the pound plummeted, and the government had to reverse course. This was a textbook example of bond vigilantes at work. Of course, nothing without criticisms and limitations. But are bond vigilantes always right? Not necessarily, not always rational. Their actions often reflect market sentiment, which can be irrational or overly pessimistic. Amplify volatility. Sudden sell-offs can destabilize markets, leading to unintended economic consequences. Limited influence on major economies. In countries with strong central banks like the US, bond vigilantes' impact is muted, as these governments have more tools to manage debt. You see, in essence, bond vigilantes are an essential, albeit sometimes unpredictable, force in financial markets. They serve as an external check on fiscal irresponsibility, but their actions also remind us of the delicate balance between government policy, market confidence, and economic stability. Understanding bond vigilantes can help you navigate the intricate dynamics of debt markets and fiscal policy. Don't forget to like, subscribe, and stay informed with our channel. Thanks for watching.